It is question number 14. It is there on your screen. Now let's look at this question. On 1st Feb 2020, XYZ, a laptop manufacturer, imported a particular type of memory chips from SKH Semiconductor of South Korea. So imported. We have imported. So it's like a foreign currency payable. The payment is due in 1 month from the date of invoice, amounting to 1190 million South Korean won. So we have South Korean won SKW payable. We are afraid of SKW rising. Okay. We have to settle the payable as less amount of rupee as possible. If I repeat in Hindi, jitna kamti rupiya jaye utna badhiya. Okay. We are afraid of SKW rising. Rupee per SKW rate. Rupee per SKW. Rupee per SKW. Following spot exchange rates 1st Feb are quoted in 2 different markets. So 1st Feb we are standing after 1 month we have a payable of 1190 million. So the spot rate is given. You can see the chupki over here, the googly. Okay, the googly USD INR is given 75/75.5. You can see it's the rate of USD. So it's a googly rupee per dollar. Rupee per dollar. If there is a googly in the sum, it means the entire sum all the rates are googly. If there is a googly, so the second rate is SKW per USD. So we have rupee per USD, we have SKW per dollar. Rupee per dollar, SKW per dollar. So if we want to find out rupee per SKW, we have to cancel. That means we have to divide. Rupee per dollar, SKW per dollar. So we will have to divide. Okay, everybody is saying that the sound is cracking. Is it? People are saying that there is some sound issue, audio issue. Initially, I asked you all, so I got a green signal. Is the sound issue fine now? Okay, people are saying now it's fine. Okay, people are saying now it's fine. Okay, so maybe if I'm putting in the collar, there is a problem occurring. Okay, let's continue. So I was saying that I don't understand so much of impatience you all show. Relax, relax, slow it down. Slow it down, please. Okay, slow it down. So I was saying that we are given the rupee per dollar rate, we are given the SKW per dollar rate. We have to find out the rupee per SKW rate. Obviously, we have to divide. Rupee per dollar divided by SKW per dollar. So we have to divide. And we need the ask rate. We need the ask rate. So 75.5 divided by 1190. 75.5 divided by 1190. Although I'm not going to do it, not the division, because we don't need the spot rate. We have the payable after 1 month. Okay. Since hedging of foreign exchange risk was part of company's strategic policy and no contract for hedging in SKW was available at any inshore market, it approached an offshore non-deliverable forward market for hedging the same risk. So when people must have read this sum in the exam, the first para would have been very easy. Okay, we have to find out the cross rate, rupee per SKW. But when they read the second paragraph, they found that it's going into some other territory, non-deliverable forward contract. Okay, because SKW contract is not entered in India. In NDF market, a dealer quoted 1 month SKW per dollar rate at 1190/1190.5. So we have to buy SKW. But the base currency is dollar. This is googly going on. The base currency is dollar, which means SKW has to be bought, which means US dollar has to be sold. So which rate is relevant over here? 1190 or 1190.5? We have to buy SKW. That means we have to sell US dollar. US dollar is the base currency. There's a googly going on. So which rate is relevant? 1190 or 1190.5? It is 1190. Okay, 1190, because we have to sell dollar. Dollar is the base currency over here. And I think the amount was 1190 million South Korean won. So 1190 million South Korean won at the rate of 1190 would actually be equal to 1190 divided by 1190. 1190 divided by 1190, which means 1 million. Okay, $10 lakh. $10 lakh. Okay, 1190 by 1190, it's $1 million. That is $10 lakh. Okay, 1190 by 1190, it's 1 million. That is $10 lakh. For a notional amount of USD 1 lakh to be settled at a reference rate. So that's misprinting. It's actually $10 lakh. They've written $1 lakh. because the amount over here was 1190 million. It was not 1190 lakhs. But we say in Hindi na, बड़े बड़े देशों में छोटी छोटी बातें होती रहती है señorita. So they can do all these mistakes because they don't understand million the way most Indians don't. Okay, so it's $10 lakh. After 1 month, that is 1st March 2020, the dealer agreed for SKW 1185 per USD as the rate for settlement, and on the same day, the spot rates in the above market were as follows. So for the NDF, settlement will take place at 1185. Now this is the rate of USD. SKW, we were purchasing long, that means USD short. SKW long, that means USD short. So if you go short on forward, you will gain if the price falls. If you go short on Reliance, you will gain if Reliance Industries price falls. If you go short on gold, you will gain if the gold price falls. If you go short, you will gain if the price falls. So on USD, we are short at 1190 and the rate has become 1185. So we have gained on the NDF. Understand please, focus on the base currency. We are buying SKW forward, that means we are selling USD forward. We are selling USD forward, short position. And USD, the rate has gone down from 1190 to 1185. That means on the betting we are gaining. Okay, to find out the gain, please convert that 1190 million into US dollar. 1190 million divided by 1185. What is it? 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 Please tell me in open form. 1190 million divided by 1185. Please tell me in open form. 1190 million divided by 1185. It is 10,04219. It's coming to 10 lakh 4,219, I think. 10 lakh 4,219. 10 lakh 4,219. Okay, 1190 million divided by 1185 is 10 lakh 4,219. Perfect. So initially it was 10 lakh dollars. Now it is 10 lakh 4,219. That means the gain is equal to $4219. The gain is equal to $4219. The gain on the NDF is $4219. I said NDF is a forward contract where there is cash settlement in dollar terms. NDF is a forward contract where there is no physical settlement. There is cash settlement in dollar terms. So initially the 1190 million was at $10 lakh, and now at 1185 it is 10 lakh $4219. So 4219 is the gain. How do you understand it's a gain? Understand please, the base currency is USD. What are you doing on USD? SKW we are long because we are buying, we have a payable. That means on USD we are short. On USD we are short, and you know that if you are short, if the price falls you gain. The price fell from 1190 to 1185. So you gain $4219. $4219 is the gain on the NDF. $4219. After 1 month, this reference rate, settlement rate is given, and the spot rate is given. Analyze the position of the company under each of the following cases, comparing with spot position on 1st Feb. Number 1, do nothing. If we do nothing, then compared to 1st Feb, what is the gain or loss? 1st Feb is the reference point. 1st Feb, what would have been the rupee outflow? Let's calculate. On 1st Feb, the cross rate of buying SKW, rupee per SKW ask rate is 75.5 by 1190, and you have to pay 1190 million. So please find out 75.5 divided by 1190, the whole into 1190. Open form. 75.5 divided by 1190, the whole into 1190 is coming to, I think, 75.5 million rupees. 75.5 million rupees. Okay, 75.5 by 1190 is the cross rate initially on 1st Feb, and that multiplied by 1190 is obviously 75.5 million rupee. This would have been the rupee outflow on 1st Feb. Although 1st Feb is not relevant, but they have made it relevant because they have written by comparing with 1st Feb. So 75.5 million would have been the rupee outflow on 1st Feb, would have been. If anybody asks me, why are we taking 1st Feb rate? That's irrelevant. Yes, you are correct. But the question is saying comparing with the spot position on 1st Feb. So we have to take 1st Feb as the basis of comparison. 75.5 million. Okay. However, do nothing. If we do nothing, then after 1 month in March, the rate is 75.75 divided by 1188. So please do 75.75 divided by 1188, the whole into 1190 million. 75.75 divided by 1188, the whole into 1190 million. What is it? 75.75 divided by 1188, the whole into 1190 million. 75.75 divided by 1188, the whole into 1190. 75.75 divided by 1188, the whole into 1190. It's coming to 75.878 million or 75.875 million, whatever. 75.875 or 88 million. 75.88 million. So it would have been 75.5 million on 1st Feb, but on 1st March, if we do nothing, our outflow would be 75.88 million. So in that case, there would be a loss. 75.88 minus 75.5. 75.88 minus 75.5. 75.88 minus 75.5. 75.88 minus 75.5. It is around 0.38 million. So in do nothing, there would have been loss of 0.38 million. 0.38 million rupees. 0.38 million rupees loss. Okay. 0.38 million rupees loss. 0.38 million. If we look at, they've written both rupee per SKW rate and final payment are to be computed in lakhs, not million. So it's 3.8 lakhs. 0.38 million means 3.8 lakhs is the answer approx. To be rounded off to 4 decimal places. I have not done 4 decimal places and all that. The rate was supposed to be found in 4 decimal places. So we are going to find some difference between our verbal answer and the CA Institute answer. You were supposed to find out 75.75 divided by 1188 in 4 decimal, then multiplied by 1190. That is what you were supposed to do. But we just did it on the calci. Okay. So if we check the Institute's answer on 1st Feb, they have calculated the rate 75.5 by 1190. We never calculated that. Calculated in 4 decimal 0.0634. That's a rounded off figure. And they multiplied by 1190, they got 754.46. We got 755.5. Or we got 755 lakhs. 75.5 million. So we got 755, they got 754.46. Their answer is correct because it's written that you have to find out the rate in 4 decimal places. It's written you have to find the rate in 4 decimal places. We were doing on the calci. Okay. So our process was correct. Find out the cross rate 75.5 by 1190 and then multiplied by the payable amount. We did straight away. They found out the rate in 4 decimal place, then they did it. So they got 754.46 lakhs. So if you talk about the sum wise, they have done it correctly because we had to find out the rate in 4 decimal places. But on 1st March, the rate is 75.75 by 1188.0638 multiplied by 1190, 759.22 lakhs. So the loss is 4.76 lakhs, not 3.8 lakhs. So our answer was not incorrect. But since we did not read the last line that we have to find out the exchange rate in 4 decimal places, hence the difference. What solutions I have seen in the past, the corrections. If somebody gives an answer of 3.8 lakhs, the institute will mark him wrong. If somebody gives 3.8 lakhs, the institute will mark it wrong. And you can't blame the institute over here because they have categorically mentioned that you have to find out the exchange rate in 4 decimal places and then use it. So if you are not reading the question, in that case, you will yourself be to blame. Conceptually on the calci, 3.8 lakhs is the correct answer. But from the exam point of view, you have to give the answer which they are getting. And this time they are not wrong. They are exactly correct. Because they have written you have to compute the rate in 4 decimal places. You have to find out the rate in 4 decimal places. The initial rate was 75.5 by 1190. Okay. And the final rate was 75.75 by 1188. Those 2 rates, the difference multiplied by 1190 million. You have to find out in lakhs. That comes to 4 lakhs something. Okay. That is the loss. If nothing is mentioned regarding decimals, what should we consider? I don't know. If nothing is mentioned about decimals, what should we consider? I don't know. Usually small exchange rates like these, which are coming up in points, decimal points, 0.06, the exchange rate, 0.0634. They have to be in 4 decimal places. But big exchange rate like 70 point something can come in 2 decimal places. So exchange rates, whether they should be in 2 decimal or 4 decimal, depends upon the value of the exchange rate. If it's a big exchange rate like 75 point something, it can be in 2 decimal. If it's small exchange rate, it has to be in 4 decimal. That's the only guidance I can give. Okay. Now, the main reason why we did the question was because of the NDF. Now in the NDF, we saw that it's 1190 by 1190, that is $10 lakh. But based on the reference rate later, 1190 by 1185, it was 10 lakh 4,219, I think. So $4219 was the profit on NDF. 4219 was the profit on NDF. 4219, that's matching. So why is this part matching but that part was not matching? This 4,76,000, because in that part we had to find out the cross rate in 4 decimal, which we did not. But in this part there is no cross rate required. We straight away use the exchange rate given, the 1190 and the 1185. Okay, so we are gaining $4219 in the NDF, but we have to find out the rupee outflow under the NDF. So to find out the rupee outflow, please understand the NDF was done separately. The NDF was done separately, but you have to ultimately pay based on the 1st March rate. So the 1st March rate, the payment which we got, that payment was 759.22 lakhs. Based on the 1st March rate, the payment was 759.22 lakhs. So that's the payment you have to make. And on the NDF, you have a profit. So that profit will reduce your net outflow. Even if you do NDF, you will settle the payable to the party. Even if you do NDF, you will have to settle the payment to the party at the 1st March spot rate. So you got 759.22 lakhs over there. But because of the profit on NDF, your net outflow would be lower. But the NDF profit is in dollar terms. So we have to convert that profit into rupee terms. We have to convert the profit into rupee terms. So the $4219 we will sell spot on 1st March. The $4219 we will sell spot on 1st March. What is the rate for selling dollar on 1st March? Rupee per dollar 75.5, 75.75. So to sell dollar, the rate is 75.5. On 1st March, you gained $4219 on the NDF. You will sell that dollar at 75.5. So 75.5 into 4219. That's the profit on NDF in rupee terms. That will be reduced from the outflow of 759.22 lakhs. Okay, 759.22 lakhs. Let's see the NDF answer. Yeah, minus the profit on the NDF. 4219 into this. So the outflow via NDF is 756.0347 lakhs. 756.0347 lakhs. Okay. Whereas on 1st Feb, the outflow would have been 754.46. So the loss is 1.5747 lakhs compared to 1st Feb. So there is a lower amount of loss in NDF. There was a bigger amount of loss if you do nothing. It was 4 lakh something. Here it is 1 lakh something. So NDF is preferred. What is preferred? NDF. I don't like the language NDF is preferred because we are able to say this on 1st March when everything happened. Okay, you can't give an advice, but they always do it this way. Okay, NDF should have been preferred is the better language, but leave the better language. Let's give the CA examination. Then we use the better language in real life. So this was the NDF thing. It's very, very important for the exam. Do not think it's a one-time affair. It has come once, it will not come in future. It is going to come again. And if you just understand it simply, in a NDF, you are entering into a forward contract betting wise. It's like a futures contract. So you find out the gain or loss in dollar terms. That will be the settlement. Cash settlement, no physical settlement. Okay.
Question number 9 is on money market. Z company issued commercial paper worth 10 crores as per the following details. The company is raising funds via commercial paper, 10 crores face value. Date of the issue 16th Jan 19. Date of maturity 17th April 19. 16th Jan to 17th April. That is 91 days. Interest rate is 12.04%. So they've given us the interest rate. That means we have to find out the price via the second formula. What was the net amount received by the company on the issue of commercial paper? Bracket charges of intermediary may be ignored. I was talking about the charges now, the stamp duty, the brokerage and the rating charges. We'll ignore all of them. Find out what was the issue price. So it's a very, very easy sum. Let's do it. We'll apply this formula. So I am writing the formula again. Price is equal to the face value divided by 1 plus number of days by 365 into the effective interest. Effective here does not mean per annum compounded annually. It is just used in the colloquial sense. So price is equal to face value is what? 10 crores divided by 1 plus number of days was 91 and interest rate is 12.04. So 0.1204. You just need to calculate this and you get the answer. Please calculate. Take your time. Please calculate. So the answer is coming to 97085,726. So how are you calculating? A student is sitting by my side. He is doing the calculation for me. 97085,726. I'm sure you all must have calculated this. So this is the price. Sir, can be calculated by the first formula? Of course you can. You could have done 12.04 is equal to 10 crores. That is F minus P divided by P into 100 into 365 by 91 and solve for P. So you can do it this way also. But that would be stupidity. I think if you're asked to find out P, better apply the formula for P. If you're asked to find out I and P is given, better apply that formula. So it's common sense. Okay. Coming to CA final, this should be very obvious to you. Now, what I was saying is that suppose in this sum, the question would have been calculate the annualized cost of issuing the commercial paper if stamp duty this much, rating charges this much, brokerage this much. Okay, so in that case, you need the 12.04%. Please understand, so 12.04 is given. If the price was given, you know how to calculate 12.04. So then what you would do is that you will take the effective interest, that is I, you will add the rating charges. These are already per annum, don't tinkle with them. Add stamp duty, but stamp duty is periodic, so you'll have to do whatever stamp duty is given, that into 365 by 91. Okay, then add brokerage. Add brokerage or dealer's commission, whatever, into 365 by 91. I am saying 91 because it's a 91-day commercial paper. Don't book me for that. Okay, so rating charge is already per annum, I is per annum, rating charge is per annum, stamp duty is periodic, so convert it into annual. Brokerage is periodic, convert it into annual, and then add, and you get the entire thing. Okay, and you get the entire thing. So this entire thing total is the cost of commercial paper. So only these two types of sums on commercial paper can come. Hope you will be able to handle. Okay. So we have STR Limited's current financial year's income statement reported its net income after tax as 50 crore. This is net income after tax. It's not net operating income after tax. So it's not no PAT. It's PAT. Net income is PAT. 50 crores. But if it's an EVA sum, we need no PAT. So you have to convert PAT into no PAT. Following is the capital structure. Debt 80 crores. Equity including reserves 250 crores. Invested capital 330 crores. Perfect. 330 crores. Following data is given to estimate the cost of equity. KE. RF is given 8.5%. RM minus RF is given 9%. Okay. So RF plus RM minus RF into equity beta, that is levered beta, but we are given the asset beta. So you know how to convert the asset beta into equity beta. You have to put leverage into it, into 1 plus D by E into 1 minus T. We'll do that. So we'll tax rate 30%, calculate EVA. This is called a clean sum, no problems at all. Okay, what is the debt? 80. What is the equity? 250. So I'm not doing it in a very sequential manner, okay, by decorating the board. Basically, my stance is how to calculate KE. So KE is RF plus RM minus RF into equity beta. Okay, equity beta is not given. So this equity beta is equal to the asset beta, unlevered beta, into 1 plus D by E into 1 minus T. Correct? So everything is given to you. You know this asset beta, you know the debt, you know the equity, you know the tax rate. So you calculate the equity beta. You put the equity beta, RF is given 8.5, RM minus RF is given. You get the KE. Okay, I'm not doing it. So you get the KE. Perfect. You get the KE. Now, KC is obviously WDKD plus WEKE. Okay, do we have the weight of debt? Yes, we do. If you look at the figures, weight of debt is 80 by 330, weight of equity is 250 by 330. Perfect. You are doing from CA into stuff. And KD is obviously 11 into 1 minus T, and KE you have already calculated. KD is 11 into 1 minus T. You can see that 7.7, and KE you have already calculated. So there is no problem in KC. Okay. KC and capital employed is already there, 330. So now you need no PAT. You are given the PAT. The PAT was given. What was the PAT? PAT is 50 crores. PAT is 50 crores. Tax rate is 30%, and interest is 11% of 80. So we have, from PAT I can calculate no PAT in two ways. One is by the shortcut method. Shortcut is no PAT is equal to PAT plus interest into 1 minus T. People are not comfortable with this generally. So 50 crores plus 11% of, what was it? 11% of 80 into 0.7. 11% of 80 into 0.7. Okay, 50 plus 11% of 80 into 0.7, that is 56.16 crores, I think. But people don't like this method. The other method is, you have the PAT, which is 50. So you calculate PBT, which is 50 divided by 0.7. What is it? 50 by 0.7 is 71.4. 286. Add interest. Interest is 11% of 80, which is 8.8. So you get EBIT. So we get EBIT equal to what? 71.4286 plus 8.8 is 80.2286. 80.2286. And then you do no PAT. No PAT is what? EBIT into 1 minus T. So the 70% of this amount. 80.2286 into 70%. 56.16. Look at the time wastage. So people should know that no PAT is after tax, PAT is after tax. Why should we do the taxation thing? But interest is deducted in PAT. Interest is not deducted in no PAT. So we got to add it back, but then the taxable issue comes in. So no PAT is PAT plus post-tax interest. If you know it, you are a more efficient person. Otherwise also you can do it this way. 56.16. So we have the no PAT. So EVA is what? EVA is the no PAT minus the KC which we have calculated into the capital employed which is given. Okay, so you get the answer for EVA. Do remember that if we have EVA 1, EVA 2 and so on and we pull them back, we get the MVA, market value added. And market value added is the excess of enterprise value over the capital employed. So the firm value or enterprise value is equal to market value added plus capital employed. And of course from the enterprise value, if you deduct the debt, you get the value of equity. So you should know the overall picture. Just that we are doing this sum, that does not mean that you have the alibi of not doing what was taught in class. Okay, we had done in class the entire structure of how equity valuation is done via the economic value added approach. Let's look at the solution. If we look at the solution here, they have converted the beta, okay, 1.36 they got the levered beta, they put it into the CAPM, they got KE 20.74, KD is 11 post-tax 7.7, then they calculated KC which is 17.58, and then they've done all that stuff to calculate the NOPAT, okay, 56.16 minus the KC into capital employed. Okay, that's the answer. This company is having a negative EVA. That means the company is destroying shareholders' wealth. It's not earning what it is supposed to earn. It's earning less than that. So somebody may jump, that's such a good company, it's earning 50 crores. It's accounting. You should calculate economic profit. Is it earning more than what is required? No, it's destroying shareholders' wealth. Anyway, so this is the correct sum of EVA which is given over here.
So first question of derivative is on cost of carry model. Okay, futures contract. I hope you remember in cost of carry model we say that futures price should be equal to the spot price. However, when we buy spot, we have to pay money. In futures we don't. We are ignoring margin. So there's an interest cost saved. Plus if it's a storable commodity, if you buy the commodity, we have to store it. We'll incur storage cost. But in future, there's no storage cost. So storage cost saved. But if we buy the commodity, we'll receive some monetary benefit from it, say dividend or interest. So that monetary benefit cannot be received from futures. So monetary benefit should be deducted. And similarly, there's some non-monetary benefit of holding futures, of holding the commodity, that should also be deducted. So F is equal to S plus net cost of carry, where net cost of carry is interest cost plus storage cost minus monetary benefit forgone minus convenience yield forgone. That was the price. How will this equation exactly be done? That depends on the data. Because if you draw a number line, S is standing at the 0th point of time today. F is known today, but from a time value of money perspective, it's standing on maturity. So we have to pick up S and send it over there. And let's see where the remaining items are there. I had explained it very nicely in class. Let's look at this question. A futures contract is available on R Limited that pays an annual dividend of 4, annual dividend, and whose stock is currently priced at 125. This is S0. Dividend is 4. They say annual dividend, so we have to assume it's standing at the end of the year. Each futures contract calls for delivery of 1,000 shares of stock in 1 year. 1,000 is the lot size, and the futures maturity is also 1 year. Daily mark to market. Treasury bill rate RF is 8%. Given the above information, what should be the price of one futures contract? So in this sum, futures price will be spot price plus interest minus dividend. Futures is spot plus interest minus dividend. Dividend is already standing over there at the end. We just need to take the spot and send it. Okay, 1 year ahead by adding interest. So 125 plus 8% of 125 minus 4. That's the answer. Second question. If the company's stock price decreases by 6%, what will be the price of one futures contract? So accordingly, if the price falls by 6%, 125 into 94%, find out the new price, whatever 117 types, and then futures price should be 117 times plus 8% of that minus 4. Correct? And I just forgot, they're asking the price of one contract. So every answer you got to multiply by 1000. Even the first answer, 125 plus 8% minus 4, you got to multiply by 1000. Even the second answer, you got to multiply by 1000. As a result of the company's stock price decreases, look at the English language. I think I'll forget my English language if I focus on them. So if the stock price decreases, will an investor who had a long position in one futures contract realize a gain or loss? Obviously loss, because you calculated the contract price in question number 1, and in question number 2 the contract price has gone down. So accordingly, the investor who had a long position F plus must have lost. What will be the gain or loss? So the answer number 1 minus answer number 2, I'm assuming that you did into 1000 while doing answer number 1 and 2. So the difference is the loss on one contract to the long position. Okay, very easy question. Thank you. So question number 1 of interest rate risk management is on FRA hedging. Okay, hedging through FRA. And we know that institute is providing wrong solution in this area, FRA hedging, but you got to follow the institute. So let us discuss it nicely so that we don't make a mistake and don't lose our marks. P Limited is contemplating to borrow an amount of 50 crores for a period of 3 months in the coming 6 months from now. Perfect. So after 6 months, we'll borrow for 3 months. Okay. We are afraid of interest rate rising. We should buy a 6 into 9 FRA. Okay, 6 into 9 FRA. The current rate of interest is 8%. I think it's irrelevant, but it may go up in 6 months' time. Yes, we are afraid of rising interest rate. The company wants to hedge itself against the likely increase in interest rate. Company's bankers quoted an FRA. Now, this is the 6 into 9 FRA at 8.3%. So, logically, when we enter into the FRA, it's a contract to borrow after 6 months for 3 months at 8.3%. So, logically, by definition, no matter whatever the rate be after 6 months, our effective cost of borrowing should be 8.3%. You know the answer beforehand. So they are writing compute the effect of the FRA, which means separately give us the profit or loss on FRA and the actual rate of interest cost to the company if the actual rate of interest under consideration happens to be 8.6% case 1, 7.8% case 2. Okay. So how will we solve the sum? In case 1, where the rate rises to 8.6%, we bought FRA 8.3% F plus, the rate rises to 8.6, so we gain, how much do we gain? We gain the difference, the present value of that. So 8.6 minus 8.3, that is 0.3% of 50 crores into 3 by 12. 0.3% of 50 crores into 3 by 12, that is the amount we gain. Okay. However, they calculate the present value. So 0.3% of 50 crore into 3 by 12 divided by 1 plus the market rate 0.086 by 4. I repeat, 8.6 minus 8.3, that is 0.3% of 50 crores into 3 by 12 divided by 1 plus the market rate, that is 0.086 by 4. So this is the profit on FRA that the bank will give us. Correct. Okay. Now they are saying that we will borrow at the market rate, correct, at 8.6%. So you find out the interest cost, 8.6% of 50 crores into 3 by 12. 8.6% of 50 crores into 3 by 12. But this interest is standing at the 9th point of time, and the present value of the FRA profit that we calculated at the 6th point of time. So logically that profit on FRA should be compounded and sent 3 months hence by remultiplying it by 1 plus 0.086 by 4. They have not done that. So what they have done, they just calculated the profit of on FRA, which I am repeating, 8.6 minus 8.3, that is 0.3% of 50 crores into 3 by 12 divided by 1 plus 0.086 by 4. That they have calculated. Then they have calculated the interest cost, which is 8.6% of 50 crores into 3 by 12. Then they have deducted both of them because one is a cost, the other is a profit, and they found out the net cost, and the net cost divided by 50 crores into 100 into 12 by 3. That's coming to 8.31%. Now this solution is wrong, but rectify it. Okay. Similarly, if the rate becomes 7.8, we lose on the FRA. How much do we lose? 8.3 minus 7.8, that is 0.5% of 50 crores into 3 by 12 divided by 1 plus market rate, that is 0.078 divided by 4. Okay. So you calculate the loss and you calculate the interest cost, that is 7.8% of 50 crores into 3 by 12. Now add both of them up, and whatever you get, that figure divided by 50 crores into 100 into 12 by 3. That comes to 8.29%. It's totally wrong answer, but that's what you got to reproduce. So question number 1, mutual fund. Now you all will remember that this type of sum is so frequent and so common in the past 10 years in CA Final AFM. I think the first of this type was that sum where we had Mr. Bachchan, Mrs. Charu and whatever. Okay. So there are 3 plans over here. Plan A is a dividend reinvestment plan. So whatever dividend is to be given, it will be reinvested at the NAV. Plan B is a bonus plan, and Plan C is a growth plan. We know that in Plan C, units will not increase, so there will only be long-term capital gain, no short-term capital gain. But in Plan B and Plan A, since units are going to increase, there could be a scope of short-term capital gain. We have done the sum in class, so I will briefly go through the sum without investing too much time over here, because the purpose of these classes is not to illogically invest time in sums that we have done. But if the same sums are very important and coming again, if we spend around 5 minutes, 10 minutes discussing certain nuances, which everybody gets it wrong, it's good, no? So take it in that way. So there was an IPO on 1st April 2009. Mr. Amit, Ashish and Arun, 3 investors, invested 2 lakh each at a face value 10 per unit. That means 2 lakh by 10, 20,000 units. And they chose Plan B, C and A respectively. Obviously, you need to be careful. They've not written A, B and C. So Amit went for Plan B, Ashish went for Plan C, Arun went for Plan A. Don't make a silly mistake, please. Now, look at the table. In the table, particulars of the fund over the period are as follows. So we are given date, dividend percentage, bonus, Plan A, Plan B, Plan C, NAV per unit. On 31st July, all the 3 investors redeemed all the balance units. Consider the following. Long-term capital gain is exempt from tax. Short-term capital gain 10% tax. Now, when these people are computing short-term capital gain, they are computing it with the help of the price net of STT. I mean to say, look at Plan A. The redemption price will be 53.75 minus the STT of 0.2% in point number C. Now, logically, the short-term capital gain should be computed based on 53.75. Now, what they have done in the solution is that they have not calculated short-term capital gain using 53.75, but they have used 53.75 minus 0.2%. However, in the footnote, they have recalculated again that you could have used 53.75. I don't understand. If you know that the income tax rules say that the short-term capital gain is to be computed based on the gross price, not the price net of STT. Why do they first do it wrong and then write in the note? So you have to take your own call. If you really want to follow ICAI, so don't use 53.75 while computing short-term capital gain, use 53.75 minus 0.2%, then give a note that no, alternate solution is I could have used 53.75. Now don't be frustrated and be angry upon me. It is upon you. If I would have been a student, I would have done it correctly. That means short-term capital gain shall be computed based on 53.75. I would have done it that way. Question number 2. You are required to calculate the effective yield per annum. It's point number 2, not question number 2. To calculate the effective yield per annum, that is annual rate of return for each of the investors. You know, in the mutual fund chapter, when they write effective yield per annum, they actually want to mention simple yield. Okay, simple yield, not the compounded yield. To suggest the name of the investor with the highest effective yield per annum with the difference to his nearest investor. That's okay. Based on the first solution, you can see which investor performed the best. Okay. So let me just discuss the dividend plan by looking at the table. I hope you are looking at the table. So on 31st July 2013, there's a 10% dividend. That means 10% of 10, And how many units were there? 20,000. So 20,000 into 1 is 20,000. That 20,000 is invested at 30.7. So 20,000 divided by 30.7. 20,000 divided by 30.7. That becomes how many units? 651.46 units. So 651.46 units we get on 31st July. And then once again, so the total units is 20,000 plus 651.46. Okay, that's the cumulative units. You have to make a column for cumulative units. Then on 31st March 2014, we have 35% dividend. That means 3.5 into the cumulative units. Okay, 3.5 into the cumulative units. Cumulative units was 20,600 something, no? So we get the dividend amount. That dividend amount divided by 58.42 shall be the number of extra units we get. And once again, that extra units will be accumulated. And so on. So we know the process, how it is to be done. Okay. So we'll get the cumulative units at the end. And all the units will be sold at 53.75 less 0.2%. Correct. And then you have to pay short-term capital gain on those units which were purchased on 25th March 2019 at 48.1. So there the short-term capital gain according to me will be 53.75 minus 48.1 multiplied by number of units multiplied by 10%. Okay, that will be the short-term capital gain. You deduct that and you deduct the initial investment of 2 lakh, you will get the profit. Whatever profit you get, that profit divided by 2 lakh into 100, that is the return over 10 years and 4 months. 10 years and 4 months. But you want an annualized return. So 10 years and 4 months is how many months? 124 months. So the return for 12 months would be into 12 by 124. There is no question of anybody thinking that, sir, this was too fast, because we have done all this. I can't redo it, no? Nor is it sensible that I keep on showing you the solution over here, how it is to be done. Just remember, there will be a problem in the short-term capital gain because they have once calculated it using 53.75 minus 0.2%, but then written a note that no, you could have used 53.75. I am in favor of using 53.75. I think they'll give marks because they've already given the note. In plan B, the bonus plan, it's still easier because on 31st March 2014, you get a 5:4 bonus. So the number of units you get is 20,000 into 5 by 4. 20,000 into 5 by 4. That becomes 25,000. So 25,000 plus 20,000 is 45,000 units. Next, 45,000 into 1 by 3. 45,000 into 1 by 3 is 15,000. We add it, we get 60,000 units. Then 60,000 into 1 by 4, that is also 7,000. 60,000 into 1 by 4, 15,000 units. So we get 75,000 units. So altogether we have 75,000 units at the end, which we sell at 22.98 minus 0.2%. Correct? And then once again you calculate the short-term capital gain. Very important. Although we have all studied in income tax that while computing capital gain on bonus shares, the cost of acquisition is taken to be 0, but institute has taken 19.95. So remember that you are supposed to do this sum wrong. You have to use 19.95 as the cost of acquisition for bonus shares. Do not teach me or send me messages that, sir, we have always learned from CA Inter that cost of acquisition is 0 for bonus shares. I am telling you what is done by ICAI. Follow the same. And plan C would be obviously easy. Okay, so this is the discussion to question number 1. The question has already been done in class. Okay, but it's still very important. So please be very, very careful about not doing any mistake in the question.
So let's move into question number 1 of portfolio management. So in portfolio management, you know, there was a topic called efficient market hypothesis, EMH. Okay, whether markets are efficient or not. So there were 3 types of market efficiency: weak form, semi-strong form, strong form. Market is said to be efficient in the weak form if technical analysis is useless, which means you can't make supernormal profit by just looking at past prices. And in order to check whether market is efficient in the weak form,
we carry out autocorrelations test or runs test. Now runs test is very, very common. Okay, it has been done in class. Autocorrelation test is less popular. But the best part about autocorrelation test is that you just have to find out correlation. Okay, and correlation coefficient, it is difficult to imagine an SFM student who will not know how to compute correlation coefficient. So let's look at the sum. So as you can see on the screen, question number 1, Mr. X is of the opinion that market has recently shown weak form of market efficiency. That's what he's thinking. In order to test the validity, he has collected following data on Sensex for the past 20 days. Now, if you look at the past 20 days, we are given the open, high, low and close. Obviously, we are interested only in the last column, that is closing price. Now, we come down. You are required to test the weak form of market efficiency using autocorrelations test, taking time lag of 10 days. So, which means that from 1 to 10 days, we will find out the change in the closing price. We will get 9 changes, that is X. And from 11 to 20 days, we will find out the change in the closing price, and that is what Y. I repeat, 1 to 10 days, the closing price change is X, and 11 to 20 days, the closing price change is Y. Look at the solution. So in the solution, they have taken the first 10 days. And they've written the closing price and the change. I think in the exam, you can save your time by not copying down the closing price. You just find out the change. Okay. And similarly, they have also calculated Y. From 11 to 20 days, they've written down the closing price and then the change. So we have the X and Y. You understood X and Y? The change in the closing price. Okay, from 1 to 10 and from 11 to 20. Now, I do not want you to prepare the columns that they have prepared. Don't prepare those columns because then you will be subject to new formulas and you won't like that. Okay. Instead, what did we learn in class? We learned in class that the formulas that you will prepare are first column for X, second column for Y, third column for X minus X bar, fourth column for Y minus Y bar, fifth column for X minus X bar the whole square, sixth column for Y minus Y bar the whole square, and last column for X minus X bar into Y minus Y bar. Correct? You know it because you have done so many times. So if you have these columns, then correlation coefficient is what? It is cov xy divided by sigma x sigma y. So you calculate covariance xy as the last column total, that is summation x minus x bar into y minus y bar divided by n. That's covariance. You calculate sigma x, that is root over summation x minus x bar whole square by n. You calculate sigma y, that is root over summation y minus y bar the whole square divided by n. And then you divide correlation equal to covariance divided by sigma x sigma y. So do not calculate as per the institute unless and until you are ready to learn new formulas. Look what formula the institute has used. These are the formulas A, B, new formulas, and then R square and then R. You can go for it if you are liking new formulas. Instead, you calculate correlation by your formulas. Okay. So correlation comes to 0.4 around 0.4. Now 0.4 is not 0. That means the price changes are correlated. That means market is inefficient. So market is not efficient in the strong form. If correlation was 0, we would have concluded that market is efficient in the strong form. You know that actually in an exam, correlation won't actually be 0. So I had given a cutoff like up to 0.2 or 0.25 it comes. Then you take it to be 0. Actually, institute has not clarified. So let's hope that either it will be very close to 0 or far away from 0 like 0.4. So market is not efficient in the weak form.